Hello everyone, in this video we're going to be going through the topic of sales returns and allowances. So sales returns and allowances is when a customer returns a product or is granted an allowance because the product is defective, the wrong product was shipped, or the product does not fulfill the customer's needs. Okay, so basically something is wrong with the product, and so we're either going to let them return it or we're going to give them an allowance, meaning we're going to reduce the amount that they owe us. Okay, we're going to say, okay, you can pay us less because we shipped you the wrong product, okay? So companies should recognize revenue for the amount of sales, for the amount of goods it sells, less an adjustment for estimated returns, and additionally, companies must reduce cost of goods sold and increase inventory for any returns or estimated returns. Okay, so basically what we want to do here is that, again, this is a topic within the overall topic of revenue recognition. Okay, so the issues that we have here are basically making sure that we record the right amount of revenue, but then also we're selling something, so we have to make sure that we record the correct amount of cost of goods sold. Okay, so let's go ahead and look at a quick example here. So we're going to do two examples. One is going to be a sale on account, and the second one is going to be a cash sale. These should be the exact same example, except for the fact that this one is sold on account, and then the other one is a situation where we have a cash sale. Okay, but the facts are exactly the same other than that. So what we'll do is we'll go through this one extensively, and then the other one will be very similar. Okay, most of the journal entries will be very similar. Okay, ABC Company is a department store chain that sells clothing, shoes, and other apparel. On December 31 of 2017, the company sold 10 shirts to Jane for $25 each. So that'd be $250 total, right? 10 times 25. So the total would be $250 in sales revenue. The cost of these shirts was $15 a piece. So that'd be $150, right? 10 shirts times $15 is $150 of cost of goods sold. ABC estimates that Jane will return 3 of these shirts. On December 31, Jane actually returns 2 of the shirts. Okay, so that means as of December 31st, which would be their year end, there would still be 1 shirt left, right? Because they expect that 3 will be returned, and she's already returned 2. Okay. Required, assuming the sale was made on account, right? So accounts receivable, right? Prepare the journal entries for ABC for the following dates: December 1, 2017, December 15, and then December 31 of 2017. December 1, okay, we're recording a sale and then we're recording cost of goods sold, right? So this is a relatively straightforward entry. We debit accounts receivable for $250 for the amount of the sale. We credit sales revenue for $250 for the amount of the sale. Cost of goods sold again is $150, so debit cost of goods sold $150, credit inventory $150. Nothing too incredibly complex there, right? It's a sale on account. We have to record the cost of the inventory that's sold. Okay. Then on December 15 of 2017, we have a return of 2 shirts. Okay, so that means that for 2 shirts, right, at $25 a piece, that would be $50 of sales revenue, and then two shirts at $15 of cost would be $30 of cost of goods sold, right? So this would be revenue here and cost of goods sold for the 30. Okay, so again, if Jane is returning these shirts, that means we have to reduce our sales revenue and accounts receivable, right? Because this is basically the same thing as saying the sale never occurred, right? This is the same thing as saying we only sold 8 shirts, right? But we've already recorded 10 shirts of revenue, so we have to reduce the amount of revenue by 2 shirts times $25, which is $50. So we're going to debit sales revenue to reduce sales revenue by 50, and then we're going to credit accounts receivable by 50 to reduce accounts receivable to show, okay, we're not going to receive this money anymore, right? Because she returned the money, she returned the shirts to us, okay? Then we have to go ahead and reduce cost of goods sold, credit cost of goods sold for 30, and then we're going to debit an account called returned inventory for 30 because we have to increase our inventory account because we actually have these shirts back now, right? We reduced our inventory to show that they were sold, but now they're not sold anymore, so they should be on our books, okay? So that would be in the account returned inventory. Then December 31 of 2017 comes around, and again, we think that there'll be 1 more shirt will be returned, okay? So on the revenue side, that's just going to be $25, right? Because it's just 1 shirt times $25. On the cost of goods sold side, that's going to be $15, right? Because again, the shirts cost $15 each. So our journal entry is a little bit different on December 31st, okay? We have to debit an account called sales returns and allowances, which is a contra revenue account. That's going to reduce our revenue, okay? So that's very similar to saying let's debit sales revenue, but we use sales returns and allowances because this is an adjusting entry, okay? So we debit an account called sales returns and allowances, and then we credit allowance for sales returns and allowances, okay? This is a contra asset account. to accounts receivable. Okay, so this is going to reduce the balance in accounts receivable by 25. Again, we're trying to say we don't think we're actually going to make this sale. And so it's not going to be a final sale, right? She's going to return this. And so again, we can't record revenue for that if we think she's going to return it. Okay. Then we have to act like the inventory was not sold on the cost of goods sold side as well. So we reduce cost of goods sold by crediting it for 15, and then we debit estimated inventory returns for 15. Why is it called estimated inventory returns? Because again, this is just an estimate, right? We're not sure if she's going to return it, but that's our best guess. Okay, so we debit estimated inventory returns to show that we're going to actually have the inventory on our books as if we never sold it, and we're going to reduce cost of goods sold by 15. Okay, now we're going to have a cash sale. Okay, let's just put these side by side because these are going to be very similar. Okay, most of these entries are exactly the same thing. Okay, so again, we have the exact same set of facts. We don't really need to go through it again because it is literally the exact same set of facts. Okay, all we're going to do is highlight the differences. Okay, so now we're going to say that this was a cash sale, and we're going to prepare the journal entries for December 1, December 15, December 31, 2017. Same dates. Okay, so December 1, okay, if we look at these two journal entries, the only difference we will see is that we're debiting cash for $250 instead of debiting accounts receivable for $250. Everything else, the credit to sales revenue, the debit to cost of goods sold, the credit to inventory are all the same. That should make sense, right? Because we're still selling a shirt. We're still selling 10 shirts for $250 total, and we're still the cost of goods sold still $150 because it's $15 each times 10 shirts. Okay. Then on December 15th, most of our journal entries are exactly the same. The only thing we'll notice is different is this credit to accounts payable. Okay, we're still going to reduce sales revenue. We're still going to increase our inventory to act as if we never sold this, and we're still going to reduce our cost of goods sold by crediting it because, again, we're saying we haven't sold this yet. Okay, but we're going to credit accounts payable, and the reason we're going to credit accounts payable is because this is a cash sale. Okay, there is no accounts receivable in this sale. Over here, we had an accounts receivable. So what we could have done was said, let's just reduce accounts receivable to show that we're not going to get this cash anymore. However, in this case, we've actually already received cash, right? So we can't just credit accounts receivable anymore. That doesn't make any sense. There is no accounts receivable to reduce. So instead, what we have to do is we have to credit accounts payable to show we have a liability. We must pay cash, right? Because we have basically $50 of too much cash, right? They paid us $250, but basically they should only owe us $200 of cash, right? So we're going to have to actually pay them $50 of cash, okay? Because of the fact that they returned this, okay? Then on December 31 of 2017, we will see that these entries are very similar. The last entry is exactly the same, and it's the same reasoning as before. This entry, we still debit sales returns and allowances, which is a contra revenue account to reduce the amount in the revenue that we record, okay? Because again, we're acting as if this is not going to be a final sale. We're acting as if that she's going to return this. Then again, we're going to credit accounts payable for the same reason as above. There is no accounts receivable to reduce, and so we're going to have to pay this customer $25 because she already paid us in cash, okay? So basically, that is the end of this topic. Again, we just did the sale on account and the cash sale. We highlighted the differences, right? We went through this one in more detail, and then we sort of used that as a springboard for the second problem. And we went through the second problem faster, mainly because most of the journal entries are identical. The only changes are the cash and then the accounts payable. Every single thing else is exactly the same, okay? And we went through the reasoning on that, okay? So that is the end of this video, and I hope that was helpful.